Election jitters weigh on European investors' moods as major US indices advance to fresh highs ahead of today's much-awaited US CPI update, the Fed decision, and the quarterly dot plot. So, today could eventually be the most crucial day of the month, with the potential to shape the global market mood for much of the summer. So, welcome. This is Swissquote's Daily Market Talk. So we have different moods on different continents this week. The European equities will remain under the pressure of heating political tensions in France on Tuesday, as the French Republican President Mr. Ciotti suggested that they should consider teaming up with Le Pen's political party, a limit that many French Republicans still consider as being a thick red line that should never be breached. Bref, the French 10-year yield continues to push higher as a result of it. The spread between the French and German 10-year yield went all the way up to 60 basis points and above, and the CAC 40 is at the weakest level since February this year, while the euro-dollar remains heavily offered. The pair is now preparing to test the 107 support to the downside, as the rise of the popularity of Le Pen's party, whether you like it or not, brings to mind the word Frexit, and investors don't necessarily like the sound of it. Meanwhile, on the other side of the Atlantic Ocean, the mood is much sunnier. The major stock indices in the US actually advanced to fresh all-time high levels on the back of a strong 10-year bond auction in the US a day before the latest CPI update and the Fed decision. So the US 2-year yield gave back a part of the post-US jobs data strength of last Friday. The 10-year yield tipped a toe below the 4.40% level. The S&P 500 advanced to a fresh record high, helped by softer US yields and a wonderful 7% jump in Apple shares on companies' AI plans that came with a 24-hour delay. In about a session time, investors went from, is this really it? Is this the plan to integrate ChatGPT on iPhones in a private and a personal way to, oh wait, this could be great indeed. Having private and personalized access to ChatGPT via new iPhones will certainly explode the sales of the new iPhone models, guys. So this is good news. So good news is, for everyone, the good mood from the US, seems to be giving a meager smile still to the European equity futures this morning at the time I'm talking here. So let's see whether this optimism could last, because we have a big day in terms of economic data and announcements today in the US, and it is even possible that what we see today could determine the market mood for the rest of the month and also a good part of the summer. So first, the US will be revealing its latest CPI update, where core CPI is expected to have eased from 3.6 to 3.5% on a yearly basis. But headline CPI is still seen steady near the 3.4% level. So these numbers are nowhere near the Fed's 2% inflation target and are not trending fast enough toward that level either. But a surprise to the downside will, of course, fuel the Federal Reserve's rate cut bets for later this year. Then, the Fed will be announcing that it's not changing its interest rate today, but will be releasing its latest dot plot, where the Federal Reserve members will plot how many rate cuts they think they could announce in the future, especially this year. Now, I'm confident that the number of median rate cuts projected by the Federal Reserve members will be less than 3. That was plotted back in March, remember? But whether this number will be 1 or 2 is yet to be seen. Now note that the major US indices advanced toward fresh all-time high levels, highs a rising stress on the banks front. Because in fact, the SPDR's banks and regional banks indices, they both declined to the lowest levels since April, as PIMCO warned of a very high concentration of troubled commercial real estate loans on the regional banks' books. And obviously, the more the Federal Reserve waits before cutting its interest rates, well, the more the commercial real estate sector troubles could rise to the surface. But on the other hand, the Federal Reserve's mandate is not to keep the US commercial real estate afloat and at a sweet spot. It's got a price stability mandate as well, remember, where it should be, well, fighting inflation. So the picture is quite complicated for the Fed, so let's see what the Fed and the Fed members think about all this. While the US yields are giving back the post-US jobs data advance, while the softer US yields do echo well across the major US indices, while the US dollar index remains upbeat despite the softening yields by inflation and the Fed uncertainties and also the political shenanigans that we have on this side of the Atlantic Ocean. But while the election uncertainty that we see in France doesn't do much good to the single currency, well, the pound sterling in Britain looks much less better, to say the least, by, well, the idea that the Conservatives in the UK will likely say goodbye to their majority next month. In fact, a recent survey from Bloomberg hinted that a Labour win in the UK would be better for both the pound, gilts, and the British stocks, which is super unusual, mind you, because it would normally be all the contrary. But because Brexit, Liz Truss, and endless infighting damaged Tories' reputation over the years, well, it is said that it's likely that the end of the normally market-friendly Tories' rule will resonate well across the British markets. So, cable is holding ground above the minor 23.6% Fibonacci retracement on April to June rebound, and the toppish view that we see today is mostly due to the US dollar strength. And, well, before I go any further from here, please note that I do not vote in France nor in the UK, and I do have no political preferences for these countries whatsoever, nor for other countries, and especially none at all in the context of the market analysis that I perform here, as I simply try to guess the market moves and the reaction and do not comment on what's politically good or bad for people, for whom, for whoever. So, back to my story. Keep that in mind, we have 22 more days to go until the UK election, and Labour in the UK holds more than 20 points lead over the Tories. And, well, yesterday's big claimant count change in the UK and the rise of the British unemployment rate to 4.4% level certainly didn't help improve Tories' popularity, even though the softening inflation in the UK has clearly helped Mr. Rishi Sunak hold his promise to halve inflation in the UK, even though the falling inflation in the UK was mostly due to the global disinflationary dynamics and partly to Bank of England's tight monetary policy. So what I'm trying to say here is that even though this week's weak jobs data from the UK increases the chances of a Bank of England cut once the election dust settles in the UK, well, the pound sterling is expected to be better off in the scenario of a Labour win, so in the scenario of a changing government than status quo. But whether cable could continue to rise, well, depends on where the US dollar is headed next. And where the US dollar is headed next obviously depends on the US inflation data, the health of the US economy and the regional banks, all the commercial real estate shenanigans, and of course the Fed. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow with a lot of news. And until then, good day trading.